December 2025, peak wedding season in India. Hundreds of thousands of passengers open their airline app and see the same word across every screen at every major airport in the country. Cancelled. On December the 5th, the on-time performance of India's largest airline, IndiGo, dropped to 3.7%. 1.62 million passengers were affected that month. The chief executive was summoned by the regulator, and 3 months later, he resigned. This is the story of how the most dominant low-cost carrier in the world nearly destroyed itself in a single week, and what it is betting everything on to survive. IndiGo was founded in 2005 by two men with very different backgrounds and one shared conviction. Rahul Bhatia ran Interglobe Enterprises, a travel services business based in India. Rakesh Gangwal was a former executive at United Airlines and US Airways in the United States. Together, they believed India's aviation market was fundamentally broken, expensive, unreliable, and inaccessible to most of the country's population. Their solution was radical in its simplicity. One aircraft type, one cabin class, low fares, fast turnarounds, no frills. The airline took delivery of its first aircraft in July 2006 and flew its first commercial flight on August the 4th of that year, from Delhi to Imphal. The aircraft they chose was the Airbus A320, a narrow-body, short to medium-range jet that airlines around the world rely on as their workhorse. By committing entirely to the single family of aircraft, IndiGo could simplify crew training, reduce maintenance costs, and negotiate bulk deals with Airbus that no airline its size had any right to demand. Every pilot could fly every plane, every engineer could service every engine. The savings compounded year after year. The strategy actually worked faster than anyone expected. By December 2012, IndiGo had overtaken Jet Airways to become the largest domestic airline in India. By 2015, it had gone public on the National Stock Exchange, and it kept growing. While every other major Indian airline collapsed under debt, mismanagement, or both, Jet Airways, Kingfisher, Go First, IndiGo kept flying, on time, at low cost, with a consistency its competitors could not match and could not explain. By 2025, the numbers were extraordinary. A domestic market share of 64%, confirmed by the Directorate General of Civil Aviation, a fleet of 440 aircraft, more than 2,700 daily flights, 94 domestic destinations and 43 international ones, and an order book of 907 aircraft, more than any other airline in the global top 20, an order book that equaled 228% of its entire active fleet. IndiGo was not just planning to grow, it was planning to transform. But underneath that dominance, something had been quietly building for years. The engine that powered IndiGo's growth was the Pratt Whitney PW1000G. A next-generation power plant fitted to the newer, more fuel-efficient Airbus A320 Neo and A321 Neo variants that IndiGo had been steadily introducing since 2016. The engine was supposed to deliver 15% better fuel efficiency, and it did. But it also came with a problem that would take years to fully surface. A manufacturing defect in certain turbine components built between 2015 and 2021 caused abnormal wear at a rate the engines were never designed for. Aircraft had to be pulled from service for inspections and repairs far ahead of schedule. Globally, more than 800 aircraft powered by this engine were grounded by late 2025 in India. Roughly 13 to 15% of the country's entire operational fleet were affected. For IndiGo, which had made the Airbus A320 family the only aircraft it operated, there was no alternative. No backup fleet, no different engine to fall back on. The single type strategy that had built the airline had now in fact become a single point of failure. By October 2025, IndiGo was operating 344 aircraft, well below the 403 the regulator had approved for its expanded winter schedule. The gap between what IndiGo had promised and what it could actually deliver was already there. Most people just could not see it yet. In June 2024, India's Directorate General of Civil Aviation had announced new flight duty time limitation rules, regulations governing how many hours a pilot can operate before mandatory rest is required. The rules increased rest periods and placed new restrictions on night flying. IndiGo and other airlines pushed back hard, delaying full implementation until 2025. The first phase came into effect in July. The second phase was scheduled for November the 1st. In the months leading up to that date, IndiGo had committed to a winter schedule of 15,014 weekly departures, a 6% increase from its summer schedule and nearly 10% higher than the previous winter. The regulator approved that schedule based on an estimated aircraft availability of 403. IndiGo was operating 344. The airline had built its entire winter operation on a foundation that did not exist. On the 2nd of December 2025, the cancellations began. A cluster at first, manageable, explainable. By the 3rd of December, the cascade had started. Pilots were running out of duty hours under the new rules. Crew scheduling had no recovery margin. Aircraft that should have been at one airport were sitting at another. The system had been optimized so completely for so long that there was nothing left in it to absorb the shock. By December the 5th, with on-time performance at 3.7%, the machine had stopped. The government's response was immediate and public. The Ministry of Civil Aviation set up a passenger hotline. The regulator granted IndiGo a temporary exemption from some of the new night flying rules, an admission that the rules had contributed to the crisis, but it also ordered the airline to cut its domestic schedule by 10%. It summoned Peter Elbers, IndiGo's chief executive, on December the 12th to demand answers. It launched a high-level inquiry, and then it published the findings. The investigation found over-optimization of operations and a systemic failure in contingency planning. It found that IndiGo had been approved for a winter schedule based on aircraft numbers it could not actually deliver, and that its crew scheduling had no buffer for disruption of any kind. The regulator issued formal warnings to the chief executive, the chief operating officer, and the deputy chief operating officer. It imposed a fine of 22.2 crore rupees, or $2.3 million, the highest ever levied on an Indian airline, and it required IndiGo to post a 50 crore rupee bank guarantee linked to a phased plan for operational reform. IndiGo's financial results for the third quarter of fiscal year 2026 told the rest of the story. Net profit fell by 77.6% compared to the same quarter the previous year, from 2,448 crore rupees to just 549 crore. To put that in dollars, that is from around $255 million to $57 million. The costs from the disruption, combined with currency losses and the impact of the new labor rules, had devastated the bottom line even as passenger demand remained strong. On the 10th of March 2026, Peter Elbers resigned from IndiGo with immediate effect. InterGlobe's managing director, Rahul Bhatia, stepped in as interim chief executive. IndiGo's share price was down 19% for the year. The airline that 6 out of every 10 Indian air travelers depended on was now being run by its founder, in crisis mode, looking for someone who had done this before. The name announced on the 31st of March 2026 stopped the aviation industry cold. Willie Walsh, Director General of the International Air Transport Association, former Chief Executive of International Airlines Group. Before that, Chief Executive of British Airways. And before that, the man who had walked into Aer Lingus in October 2001, 6 weeks after the September 11 attacks had sent global aviation into freefall and restructured an airline on the verge of bankruptcy. Walsh had started his career as a cadet pilot at Aer Lingus in 1979. He became one of the airline's youngest captains while simultaneously earning an MBA from Trinity College Dublin. When the September 11 crisis hit and Aer Lingus was facing collapse, he eliminated 2,000 jobs and cut costs by 30%. The airline survived. He earned a nickname that followed him for the rest of his career, Slasher Walsh. He then led British Airways from 2005 to 2011, steering it through the 2008 global financial crisis. negotiating some of the most difficult union agreements in British aviation history, and overseeing the merger of British Airways and Iberia in January 2011 to create International Airlines Group, one of the largest airline holding companies in Europe. He ran IAG until September 2020, then took the top job at the International Air Transport Association, the global airline trade body, in April 2021. His tenure at the International Air Transport Association ends on the 31st of July 2026, and he is expected to take charge at IndiGo no later than August the 3rd of 2026. The market's immediate reaction told its own story. IndiGo shares jumped 4.4% on the announcement, but the stock was still down 19% on the year. The market was saying something precise. Walsh is the right person, but the problems are real, and they are not going away on their own. And those problems now include something far larger than the December meltdown. They include a strategic question that Walsh will have to answer from his first day in the role. IndiGo has agreed to order 30 firm Airbus A350-900 aircraft, with purchase rights for a further 70 at its discretion. Deliveries are expected to begin in 2027. This is the aircraft that will take IndiGo beyond the Airbus A320 family for the first time in its 20-year history, beyond narrow body, beyond short and medium range, into wide-body, long-haul international aviation. Walsh himself, before he was named chief executive, had already framed the stakes in the harshest possible terms. Speaking publicly about India's aviation infrastructure, he called the country's wide-body situation a scandal. India, with a population of 1.4 billion people, operates only around 50 wide-body aircraft in total. That is roughly one wide-body jet per 28 million people. To put that in perspective, United Airlines alone operates more wide-body aircraft than the entire country of India. IndiGo also took delivery of its first Airbus A321 XLR in January 2026, a narrow-body aircraft with extended range, capable of flying routes like Delhi to Athens non-stop. It is not a wide-body, but it is IndiGo's first real step toward the kind of international network that the A350 order eventually makes possible. The question Walsh walks into on August the 3rd is this: can an airline that was built entirely around one aircraft type, one engine supplier, one cabin class, and one domestic market transform itself into a global carrier while simultaneously repairing the operational breakdown that nearly destroyed it? These two challenges do not simply coexist. They compete for the same management attention, the same financial resources, and the same organizational capacity. Walsh has fixed broken airlines before. Aer Lingus in 2001 was smaller, but it was existential. British Airways in 2008 was larger, and he held it together. IndiGo is something different again. Not a sick airline, but a dominant airline with structural vulnerabilities that its own success had hidden from view for years. The December meltdown did not happen because IndiGo was weak. It happened because IndiGo had optimized itself so completely, so relentlessly, for a world that did not include simultaneous engine groundings and a regulatory overhaul in the same winter. When that world arrived anyway, there was nothing left in the system to absorb the shock. Walsh's first job is not strategy, it is recovery. Rebuild the operational buffer, restore passenger trust, demonstrate to the regulator and to the market that this airline can handle what comes at it. Only after that does the long-haul gamble get its chance. So here's the question we're sitting with. IndiGo holds 64% of the world's fastest growing aviation market. It has 907 aircraft on order, 30 Airbus A350-900s arriving from 2027, and one of the most experienced airline executives alive starting as chief executive in August 2026. Does that combination make IndiGo unstoppable? Or does the December crisis tell us that the bigger this airline gets, the more dangerous its single points of failure become? Drop your answer in the comments below. If this kind of deeper look into the structural reality behind the airlines we fly is what you come here for, hit that like button and subscribe to Explain so you are here when the next chapter unfolds. Thank you for watching this video, and I will see you in the next one.